Okay, good morning. Today we're starting out with a question as usual. The question should look familiar. It's from last week, and I was looking to see how we do on this, and actually we're doing pretty well. Out of these accounts, last week we talked about liabilities, and out of all these accounts, which item is not a liability? And pretty good response so far. The reason I keep beating this drum is the answer is not unearned revenue. Unearned revenue is a liability. Unearned revenue is when people have paid us before we've actually performed the service or delivered the goods. Unearned revenue is things like gift cards, tickets we've sold to upcoming events, magazine subscriptions we've sold. So the answer here, investment in bonds, is an asset. When we say investment in bonds, we've purchased an investment in another company's bonds. So that would be the answer there. Okay. And that question will stay open for a few minutes, an undetermined amount of time. Today we're doing Chapter 10. Chapter 10, we're now in stockholders' equity. So we've moved down the balance sheet. The first part of the class, the first several weeks, we did the assets. Last week we did liabilities. This week we're doing stockholders' equity. And so this week we're actually finishing the balance sheet, and after this week we move on to income statement, statement of cash flows, and financial statement analysis is coming up. So, stockholders' equity. Before we get into stockholders' equity, a couple announcements. First of all, the Chapter 10 homework is due this weekend. I am going to send out links to all the homework again. I'll do that this afternoon most likely. And so if you want to get started on the homework early, you can do that. I don't have a slide for it, but looking ahead, next week we're doing Chapter 11. And we're going to do Chapter 11 on Monday. We won't get through everything, but Wednesday, all university classes are canceled after noon. Obviously, ours is not canceled, but historically, and I know people want to get home, they want to get home to family. To me, Thanksgiving's an awesome thing. I love family events, and I love being home with my family. But anyways, so Wednesday next week, we do not physically have class. We will not have it live online. What I'll do Monday, we'll get through the high points of the chapter on Monday, and then I will provide links to homework problems and additional lecture items just to fill in the blanks so you can take what you need out of that. So we will not have class the Wednesday before Thanksgiving. It's not online, it's just we're not having class because everyone wants to get home. And it's not popular having class on Wednesday before Thanksgiving. So we have class today, we have class Wednesday, that's Chapter 10. Next week is Chapter 11, and we'll be fine. And then we come back and finish up the last two chapters, the last 2 weeks. Okay, so we're going to start Chapter 10 today. And Chapter 10 is about stockholders' equity. Stockholders' equity, if you see stockholders' equity, you know the company form has to be a corporation. The form of business is a corporation, and we're going to start by talking about the features of a corporation. So we're kind of circling back to the first week or two where we talked about the different forms of business. You could be a sole proprietor. Sole proprietor, there's one person in charge that owns everything, can do whatever they want, but they have unlimited legal liability. Then the next form of business we talked about was a partnership where you join with 2 or more people and carry out your business. The drawback there is you have unlimited personal liability as well. And so then we get to corporations. And corporations are a form of business where we issue stock in the company. That's a form of ownership, and you can sell stock in the company, and a lot of different people can own your company by owning the stock. So, features of a corporation. So, advantages and disadvantages. This is Exhibit 10.1 in your book. The advantages, we can raise more capital than a proprietorship or partnership. Because if we're a corporation, we can sell stock in our corporation to thousands and thousands of people. Whereas if we're a sole proprietor, our options for getting money are going to go to the bank to borrow money. I mean, that's pretty much it. Partnership, we bring in partners. How many partners do we want? How many people do we trust to work with us? So we have corporation. We can raise a lot more capital than the other forms. Continuous life. A corporation has unlimited life, meaning when a shareholder dies, their shares of stock go to their estate, but the corporation continues on. Whereas if you have a sole proprietorship and you die, your business is technically done. Somebody can restart it, but it is a different business. A partnership, if a partner dies, the partnership is gone as well. They have to reorganize. Ease of transferring ownership. To transfer an ownership in a corporation, you simply transfer your stock, sell your stock. Proprietorship and partnership, not as easy. And with a corporation, you have limited liability of the shareholders. The shareholders are only liable for up to the amount they have invested. So those are advantages of why you would want to be a corporation. Okay, disadvantage. With a corporation, one of the disadvantages is that the owners are separated from the management. Why is that a disadvantage? Because they might have different goals. And we see this in corporations. Corporations are continually trying to get the best return for the owners. Because when someone buys stock in a company, many times that someone is not emotionally attached to the company, they want the highest return for the money. You have managers in the company that like the people in the company, that likes the company, that believe in the company's goals and all that, but they have maybe a different set of motives than the shareholder who wants the bottom line, wants a return on their investment. Double taxation of profits. A corporation is subject to double taxation. How this works is a corporation, because it is a legal entity, pays tax on its profits. So a corporation every year files a tax return and pays income tax on its earnings. A sole proprietorship, the business does not file a return, the individual does. So if I own a business as a sole proprietor, I'm going to file a Schedule C. And my Schedule C, I'll put all my income on and I'll pay tax on that income. Fine. If I'm a partnership, the partnership does not pay taxes. The partnership files a return, but the income flows through to each of the partners, and the partners report the profits of the partnership on their own personal return. So sole proprietorship and partnership, you pay taxes on the income. It flows through to your personal return. On a corporation, on the other hand, a corporation has its own tax return, and the corporation files a tax return and pays its own taxes. Okay, so that's one set of taxes. But then when the corporation pays shareholders dividends, the shareholders, who are the owners of the corporation, the shareholders have to pay tax on the dividend revenue they receive. So that's why we say there's double taxation, because the corporation pays tax on its profits, and then the shareholders, the owners of the corporation, pay tax on the dividends they receive from the corporation. So that's one of the disadvantages. And then corporations are heavily regulated. Not sole proprietorships and partnerships are not regulated nearly as much as corporations. But corporations have to be, because you think about it, we have a lot of investors investing in a corporation where they don't know anybody there. They're putting their hard-earned money into the corporation, and they need protection that the corporation just simply can't take their money and run. So there's a lot more regulation of corporations. Okay, so when we talk about a corporation, at the very top of its authority structure would be the shareholders. Shareholders and stockholders mean the same thing. Okay, so we have shareholders are the owners of the corporation or stockholders. They elect the board of directors, and the board of directors then selects the chairperson of the board, and then the chairperson of the board and the chief operating officer, and then they lead the vice presidents, and then we have everyone else in the corporation. So the shareholders are really the top of the organization, but they can't run it day to day because there's potentially millions of shareholders. So shareholders elect the board of directors who then says, well, here's our CEO, here's our COO, and then those two run the corporation day to day. Okay, so as a shareholder, so now we're going to talk about this from the standpoint of a shareholder. So you've purchased stock in a company. So you've invested in a company. What are your rights? First of all, you have voting rights. And this is the right to vote on issues that come before the shareholders. So some common things you can vote on. You can vote whether to say okay to the public accounting firm that company has chosen to do its audit. You have the option, a lot of times we'll see that companies will go to buy another company and they'll make an offer to another company. They'll make an offer to another company, the shareholders of another company, to buy them out. And as a shareholder of that company that's getting bought, you have the right to vote on whether you accept that offer or not. So you have the right to vote. You also have the right to vote on the executive's compensation packages, even though your vote is advisory only. It doesn't say yes or no. It just says, do you agree with it or not? But a lot of times things come before the shareholders, and you can make those votes. You also have the right to receive a proportionate part of any dividends. That means if you own a share of common stock and they pay common stock dividends, you get your fair share. You get your relative proportion of dividends. Okay. Next set of rights is liquidation. Liquidation is the right to receive your proportionate share of assets if the corporation liquidates. If there's anything left over, you own, for example, if you own 10% of the shares, after they liquidate, anything that's left over, you get 10% of, and that's called liquidation. And then preemption, the right to retain your proportional share in the corporation. So you have the right, if you own 10%, to continue to own 10%. They can't suddenly issue a bunch of shares and leave you out. Okay, now, when we talk about stockholders' equity or shareholders' equity, it's typically stockholders' equity. Another term for it, sometimes you'll see the word capital, but typically stockholders' equity. There's two main categories of it, and the first category is paid-in capital, and the second category is retained earnings. Okay, so paid-in capital. Paid-in capital, and this is a lot of vocabulary we're going to be using coming up, and so paid-in capital is also called contributed capital. It's the amount of equity shareholders have contributed. What does that mean? It means when we issue stock, it's what shareholders have paid us for our stock when we originally issued it. Okay, and paid-in capital includes the stock when we sell it and any, we're going to see some other things where we have an account called additional paid-in capital. So paid-in capital is this general category that includes the proceeds from when we issue stock. Then the other category is retained earnings, and we've seen this before. Retained earnings is a running total of all our earnings to date reduced by dividends declared. And we're going to talk about dividends today too and what happens with those. So retained earnings is this running total of income to date less any dividends declared. Okay. So we have paid-in capital and we have retained earnings. Paid-in capital is the stock that we've issued. There are two types of stock corporations can issue. The two types of stock corporations can issue is common stock and preferred stock. Those are very specific terms. Common stock is the name of the stock. Common does not mean frequent or generic or anything like that. It's common stock. And then there's preferred stock. Okay. Every corporation will have common stock. Every single corporation will have common stock. So common stock is the basic form of stock. It has the 4 basic rights that we just talked about, the voting rights, the liquidation rights, etc. And these shareholders benefit the most if the corporation succeeds, meaning if the corporation makes lots and lots of money and the value goes up, common stock is going to go up as well. These are the shareholders that will do really well if the corporation does really well. Common shareholders of Apple back in the beginning have done really well. Common shareholders of Microsoft from back in the beginning have done really well. But common shareholders take a lot more risk than preferred stock. Common shareholders, if the business goes out under, if they liquidate, they are last in line. They will get nothing back until every liability is paid and every preferred stockholder is paid. That is when common stock will get paid. So common stock, you're risking everything. You are absolutely last in line in times of trouble. If you go bankrupt, your common shareholders are last in line, probably not going to get anything back. Okay, so common shares. Common stock, every single company has it. Preferred stock is a lot less common. Preferred stock is not issued by most companies, but it's issued by enough companies that we need to talk about it so you're aware of it. Preferred stock is called preferred stock because you receive dividends first. If the company pays dividends in a given year, preferred stock has to be paid. So if a company only has so much money, that money will be paid to preferred stock. They're first in line. During liquidation, if the company goes bankrupt, the preferred stockholders are first in line to get their money back ahead of common stock. Liabilities are always first. If you liquidate, your creditors get paid first, and then your preferred shareholders, and then if there's anything left over, it goes to the common shareholders. Preferred stock, though, you receive a fixed dividend. That means you receive the same dividend every single year. Okay? So the company could do really, really well, and you're still going to get exactly the same dividend. Preferred stock is not that common, not that frequent. Companies don't have to issue it. Sometimes they do. So we have to know it exists. Okay, one more slide with vocabulary on it with this, and it relates to common stock. Common stock can be par value stock or no par stock. Par value is an arbitrary amount assigned to a share of stock. You can have $1 par stock, you can have 1 cent par stock. It's considered legal capital. It's usually set low, meaning the reason companies will set it low is in many states it's illegal to issue stock for less than its par value. Corporations, by the way, when corporations are set up and they have articles of incorporation, that is governed by state law. State law varies widely, so all of this is generic information relating to when your stock is issued. You have to abide by the state in which you incorporate. And so par value is a legal term. It has no relationship to market value. It's usually set pretty low. You're going to see when it's considered legal capital, we're going to do journal entries, and par value is important to us. But other than doing the accounting for us, par value doesn't really do much. So we have par value. We can also have no par stock to confuse the issue. So we can have par value stock, we can have no par stock that doesn't have par, and then if it's no par stock, it can have a stated value. So we have all these terms floating around, and we just need to be aware of what they mean, and we're going to show some examples of these types of things. Most often, you're going to see par value, you're going to see stock. When you look at a company's financial statements, you're going to see that their stock has like a 1 cent par value. I think Apple stock actually has its par value on a share of common stock is 0.00001 cents or something. So it's just a fraction of a cent. So that's its par value. You can also have no par stock. We'll see that coming up. And then you can have stock that it doesn't have a par, but will have a stated value, which works kind of like a par. So basically, we'll be looking for the most part at par value and then a little bit of no par stock. Okay, so we're going to start with the issuance of stock. So what happens when a corporation issues stock? What impact does it have on that corporation? Okay, so let's assume we're going to go through some really basic journal entries here. So let's assume, for example, Home Depot needs $100 million for expansion. So it issues stock for $100 million. Assume that its common stock carried a par value equal to its issuance of $10 per share. So we're going with, we issued it for par value. This is the simplest case. And if we do that, if we issue stock for par value, we're going to debit cash. This is Home Depot. So Home Depot issues the stock for $100 million. It's going to debit cash, and it's going to credit common stock for the $100 million. Common stock is always credited for the par value. In our case, the par value equals the market value. Usually not going to happen, but we'll start out with this easy example. Okay, so what I would advise when we're going through these now is just having each of these sample journal entries. There's a handful. We're going to go through 4 right now. So there's 4 journal entries. Just label them what they are, and this is how you account in each of these situations for the issuance of stock. So this is the, simple case. We issue stock at its par value. Okay. The next situation, let's assume that now the difference is we have the difference between this one and the slide before is now our par value is 5 cents. Okay, so our par value is 5 cents. So what we do now is our cash doesn't change, but the common stock will always be for only the par value. So we take those 10 million shares times the 5 cent par value, and that's where we're getting the 500,000. Common stock will only ever get the par value. That's it. Okay, and then the account that gets the excess is paid in capital. That'll be the difference between the cash and the par value. Okay, so we'll credit paid in capital. Sometimes that account can also be called additional paid in capital, and these are actually the names of the account. So this is paid in capital. Paid in capital is the excess of the additional paid in capital is the excess of the par value, the market value over the par value. So common stock, the rule of thumb, the rule to keep in mind through all of this is common stock is always credited to the par value, and that's it. You have to have some additional paid in capital account for the extra. Okay? So common stock will only ever get the par value. Okay, so in this situation, now we're going to switch to looking at the balance sheet and see what happens. So Home Depot, let's say if this was their only stock they ever issued, and the stockholders' equity section, you would see, first of all, common stock. Common stock will be listed first. Now, common stock will be listed. It will tell you what the par value is. Okay? So it's telling us right here what the par value per share is. Now, it's going to give us three different names here, three different terms, and these we do have to know. Okay. Okay. 10 million shares authorized. A corporation, when it's incorporated, says we will be authorized. The articles of incorporation say that this corporation can issue this many shares ever. So they pick an enormous number. In this case, 10 billion shares authorized. So authorized means in its articles of incorporation, this is the most shares that this corporation will ever issue. So they pick a huge number typically. The next number issued is how many of the shares the company has actually issued. So in our example here, Home Depot, we assume this is the only stock issuance they've had. They've issued 10 million shares. And then the third term is outstanding. And outstanding is how many shares are still out in the hands of shareholders. Companies have the option to buy their own stock back. And we'll talk about that coming up. But outstanding is how many shareholders, how many shares are in shareholders' hands still. Okay. So the 500,000 is the par value. The number right below that, the 99,500,000 is paid in capital. That's that extra that was paid above the par value. And we get total paid in capital. We add the retained earnings and we get total stockholders' equity. So stockholders' equity, again, is two components. We have paid in capital and we have retained earnings. So paid in capital is going to be common stock for the par value and then additional paid in for the excess. Okay, so now we're going to do a quick little example of no par stock because it's frequent enough that we have to see it. So next, let's say Apple, we're just going to assume they have no par stock. They have stock value on their par value on their stock that's extremely small, but let's assume it's no par stock. So let's assume that Apple issues 939 million shares of no par stock for $16,422,000. So the issuance, when you have no par stock, super easy. You debit cash, you credit common stock. That's it. If there is no par value, it all gets dumped into common stock. Okay, so if we have no par stock, don't need to memorize this. It's the same stockholders' equity section. There's just all the stock is in common stock. Okay, and then one last journal entry before we move on for what if we issue stock for something other than cash. This frequently happens if you go to start your own business. A lot of times instead of contributing cash, people will contribute things, like they might contribute a building or they might contribute a machine. If they've been operating a business themselves and they go into business with another person, they'll say, well, I'm going to contribute the equipment that we need. So in this case, an example, November 12th, Con Corporation issued 15,000 shares of its $1 par common stock with a market value of $4,000. For equipment with a market value of $4,000 and a building with market value of $120,000. So what happens is the corporation issued stock, 15,000 shares of stock for a building and equipment. So the rule when we do this, when we issue stock for something other than cash, is we value the things that we're getting. This is the corporation. The corporation values the things it's getting at market value. So in our case here, we're going to value equipment at the market value. So equipment will be at the market value. will value building, and both of those are debited because they're assets. The corporation now has equipment valued at $4,000. It now has building valued at $120,000, so those are both debited. Okay, so now common stock. Common stock is always, always, always credited for the par value. So we had $1 par common stock, so common stock always gets the par value. That is the rule with everything. So we come up to any kind of problem, common stock gets the par value, so that's the par value of the $15,000, and then that paid-in capital account, that paid-in capital gets everything in excess of that. Basically, it's a plug figure. What we're going to do is we're going to say we have $124,000 of debits. We're going to subtract this $15,000, and that's how we get the $109,000 to issue this common stock. Okay, so this was the one we issued for equipment in a building. If you have the PowerPoint slides, the very next slide looks very similar, and just make a note that we can also issue common stock for services, and again, we're going to value the services at the market value. Common stock gets the par value. So again, if you have these slides, I just wanted to point out that one. So what we're going to do right now is we're going to do a couple questions. Okay, so the first question. We issue when 100 shares of $1 par value common stock are issued at $25 per share, capital stock in excess of par value, common stock will. Okay, so it's saying we issued $1 par valued share. We issued shares of stock that were $1 par value. We issued them for $25. So what will the paid-in capital in excess of par account hold? How you're going to do this one, if you don't have it answered yet, or even if you do, make sure you're right here. What we're doing is we're saying when we issue stock, the stock proceeds, the cash goes in one of two, or the amounts go in one of two places. First of all, par value, so in this case, $1 per share is going to go in common stock. The excess will go into paid-in capital. So in this case, we issued it at $25 a share. Par value is $1 a share. So we have $24 a share that goes into paid-in capital in excess of par value. So we have $24 a share. We sold 100. We issued 100 shares. So 100 shares times $24 a share is going to give us an increase in paid-in capital of $2,400. Okay. So that paid-in capital in excess of par, that is an account name, it's a very long account name, but your paid-in capital in excess of par is going to go up by $2,400. I'm going to close this question in about 10 seconds. Okay, let's try another one. Okay, if stock is issued for an asset other than cash, the asset should be recorded on the books of the corporation at what? Fair market value, B, cost, C, par value of the stock, or D, 0. Okay, if stock is issued for an asset other than cash. So let's say we issue it for equipment. The equipment should be recorded on our books at what? When we issue stock for equipment or a building or services, let's say we issue stock for legal services, the rule is that we record it we record that item, the asset, in this case an asset. If we issue it for an asset, we record the asset for fair market value. That's it. Okay, we record the asset at fair market value. If we issue stock for legal services, we're going to record the legal services at fair market value as well. So in our case here, we issued stock for an asset other than cash. That asset should be recorded on the books of the corporation at, the rule is always we record it at fair market value. That asset is going to be recorded at its fair market value. I'm going to close the question in 10 seconds. Okay. Okay, now this third question, I'm not delivering it yet because I want to talk through it before we do that. Okay, so Wolverine Corporation issued 5,000 shares of $5 par value common stock in payment for attorney services of $40,000. So what this is telling you, this first sentence is telling you those attorney services, legal expense, the fair market value of that legal services or legal expense is $40,000. That's what that first sentence says, is, boy, these legal services that they got were worth $40,000. And then it tells us Wolverine stock has been actively trading at $20 a share. Okay, so when we record this entry, and this is where I'm going to have you write it down right now because you're going to need it for the next question too. Here's 2 gimme questions. So when we record these attorney services, the first thing we're going to do is we're going to debit legal expense for $40,000 because that's the fair market value. Okay, so we debit legal expense for $40,000. Now, we're going to credit common stock for the par value. In this case, the par value is $5 times the 5,000 shares. So your credit to common stock will be $25,000. Okay, and then you'll have one more credit. What your credit there will be $15,000. You'll have another credit, and that credit will be to paid-in capital. It's actually called paid-in capital in excess of par. Okay, so your journal entry for this transaction will be to debit legal expense for $40,000, to credit common stock for $25,000, and to credit paid-in capital in excess of par for $15,000, right? Okay, so that journal entry that I just gave you is the subject of this question I'm going to deliver now and the immediate one after it. So to give me at this point because we've gone through the answers. So this one is coming out to you right now. Should be there. Okay, I'm going to close this in 10 seconds. Okay, so again, we would have debited legal expense, okay, for the $40,000, the market value. Then on your journal entry you have written down, the credit to common stock would be for the par value, the $25,000, and you would also credit paid-in capital in excess of par for $15,000. Okay, that is the journal entry. So the next one coming up is asking you which of these would be in that journal entry. The journal entry we just went over, what's the other? Okay, I'm going to close this in 10 seconds. Okay, so that was that other journal entry. So 2 give me questions there. Again, the fair value of the attorney services, what's the $40,000? That's what we debit. The par value, $25,000. The difference between those two, it goes into the paid-in capital in excess of par. Okay, preferred stock. Preferred stock. Just a note, it's going to follow the same patterns as common stock. That's all you need to take away from that whole thing. Okay. Now, earlier when we saw the example of how stockholders' equity is on your balance sheet, there were 3 terms. The first term is authorized. This is the maximum number of shares a company can ever issue according to its charter. Issued is the number of shares of stock the company has issued to its shareholders. And then outstanding it's the number of shares that stockholders own. Companies can buy their own stock back. We'll talk more about Wednesday about why they would do that and some examples of companies buying their own stock back. Outstanding is what is actually the number of shares out in shareholders' hands. So outstanding can be the same as issued, but typically it's lower. Outstanding will never be greater than issued. These numbers pretty much authorized is the largest number, issued is the next largest number, and then typically outstanding is the lowest number. Okay, we're going to do a homework problem now. Okay, so short exercise 10.5. We're actually going to do 2 journal entries. We're going to do 1 set of journal entries to issue and buy stock in separate transactions. And so we're going to start with case A. Case A says we issued stock and bought assets in separate transactions. So case A tells us Odell issued 17,000 shares of $25 par value common stock for $756,000. So the first thing it did was it issued stock for cash. And then a second transaction, they took the cash and they bought a building and equipment. So what we're seeing in that first case A is they're issuing stock. When we issue stock for cash, we're going to debit cash for the total amount of cash. We're going to credit common stock for the par value. This has $25 par value times 17,000 shares. And then the difference goes into paid-in capital in excess of par for the $331,000. So that's our issue stock journal entry. Okay, now the second transaction they did, it says in case A, Odell used the cash to purchase a building for $548,000 and equipment for $208,000. So what we're going to see there is we're going to have our building debited for $548,000, and we're going to have equipment debited for $208,000, and then the cash is going out for $756,000. So we issued stock, got the cash, then we turned around and took the cash and bought equipment and a building. And that's what goes on with case A. Okay, we're going to do case B, but before we go there, I want to point out one thing on this one. We have building and equipment have balances of $548,000 and $208,000. We have common stock and paid-in capital. We took our initial cash that came in and we spent it down here. Okay, so in case B, what case B is doing is saying, oh, instead of issuing our stock for cash, we issued it for a building and equipment. So case B, there's no cash involved, but the same numbers. So what we're going to see in case B is our building and equipment are the $548,000. We credited common stock for the par and the excess, and we have exactly the same balances that cash. We simply didn't do it as 2 entries. We don't have the cash coming in and the cash going out. That's why when companies Typically, when you incorporate, a lot of times you bring things to the transaction. You get stock instead of in place of things, and it works exactly the same way as the company giving out cash or getting cash and then spending it. So the point of this exercise, when you do this homework exercise, the account balances are all the same after the transaction is done. Okay, we can do it as two separate transactions, or we can do it as one. Okay, now we're going to do one more homework exercise briefly. And the second homework exercise is short exercise 10.6. 10.6, we're just looking at preparing the stockholders' equity section of the balance sheet. And we're given a lot of numbers. These numbers all do not belong on stockholders' equity. The very first thing I would do when I go through here is I would go through and pick out things that are not stockholders' equity. So when I go through here, just identifying in the table what things are stockholders' equity and what things are not. Paid-in capital in excess of par is stockholders' equity. Other stockholders' equity is common stock. Long-term debt is not, because long-term debt is a liability. Total revenues is on the income statement, not on the balance sheet. Accounts payable is a liability, so it's not on the balance sheet. Other current liabilities are not on the balance sheet. And total expenses are on the income statement, not the balance sheet. Okay? So we've just wiped out a lot of things that do not belong on the statement of stock, on the stockholders' equity section of the balance sheet. So that's the first thing. When I tackle this homework problem, know that you're not going to put everything on the statement. Okay, so the first thing, so we have a stockholders' equity section of the balance sheet. First thing we're going to do is put the common stock on. Common stock is, we usually write the word common stock, and then we'll write the par value per share. This is 1 cent par value. Tells us 900,000 shares issued and outstanding. Okay, next item down, paid-in capital in excess of par. So what we're doing is we're taking common stock, the paid-in capital account. Common stock is typically the first thing in stockholders' equity. Okay, so common stock, paid-in capital. The next item down is retained earnings. So we're going to have retained earnings, so we're just taking those items off. And then the final item is this item in the table called Other Stockholders' Equity. Other Stockholders' Equity, a negative amount. Why is that in there? I have no idea. If I were writing this book, I would not have this item here because it's really a little bit beyond us, but it just goes to the bottom. So when you do this exercise, stick that other one in down at the bottom. It tells us it's negative, so make sure you put the brackets around it. So then what we end up with, then we sum it at the end. We put a single underline, total stockholders' equity. We add it up. Make sure you subtract that negative other stockholders' equity item. Okay, so that got us through the section on issuing common stock. The next section we're doing is something called treasury stock. Treasury stock is a special thing. Treasury stock is our own stock that we bought back. So we said that issued stock and outstanding stock are different. Outstanding is the number of shares out in shareholders' hands. The reason outstanding is lower than issued is because we bought back our own stock. This is treasury stock. Treasury stock are issued shares that have been repurchased by the company. Okay, so reasons that a company might buy its shares back. If they want to make the shares available for employee stock purchase plans, they might think their stock is priced too low, so they're going to buy it back and reissue it when it's higher. They might want to avoid takeover. they want to increase earnings per share or use in a share repurchase program? Okay, you know the company Caterpillar makes the big equipment? Last year, its revenues fell, its operating income fell, and its net income fell, meaning got lower than the year before. Almost every performance measure it did worse on. The CEO of Caterpillar gets a bonus based on company performance. The CEO of Caterpillar got a $2 million bonus last year for high performance. So how did he get the bonus? Well, what they did, he sits on the board of directors, by the way, and the board of directors is the ones that issue share buybacks. So what Caterpillar did last year, sometime during the year, because I'm sure he saw that everything was down. Caterpillar sales were down, operating income's down, net income's down, and he's thinking, my bonus is at risk. His bonus is actually based on earnings per share, which is basically earnings per share is taking your net income divided by the number of shares that are out there, okay? So he's looking at total revenues are down, operating income's down, net income's down. His bonus is based on earnings per share, which is net income per share, basically. So what does he suggest they do to the board of directors during the year? He says, let's buy back a lot of our shares. So let's just go out and buy all these shares back. So Caterpillar went out and bought a ton of its own stock back. So as soon as it buys its own stock back, it's no longer counted as one of the outstanding shares. So Caterpillar's earnings per share last year went up, and its executive, its CEO, got a bonus because the earnings per share went up. Now keep in mind, the revenues went down, operating income went down, net income went down. The only reason earnings per share went up was because Caterpillar bought back its own stock to make that denominator lower. So that's one of the reasons that companies will buy their own share back. And that one's kind of an ethical issue because you think about, was it ethical for him to sit on the committee where he determines the terms of his bonus, and then he's voting on, well, let's buy back our shares of stock. Lots of companies buy back their share of stock for lots of reasons. Sometimes they have employee programs where they're giving stock back to their employees. There's all kinds of reasons, but that's just an example of a recent one that's been in the news. Okay, treasury stock is easy to record. When you buy it back, you just record it at what you bought it back. So when you buy treasury stock back as a company, you go out to the market, you buy your own stock back, you're going to debit treasury stock, you're going to credit cash. Treasury stock is a contra stockholders equity account. That means it's backwards from everything else. Contra stockholders equity account, it has a debit balance. So when you buy it back, you're going to be debiting treasury stock. Okay? Debit it for cost. That's it. You don't have to worry about par value. You don't have to worry about anything. You buy your own stock back, it all gets debited to treasury stock and gets credited to cash. That's it. It is a contra stockholders equity account. It has a debit balance. It reduces stockholders equity. When you buy treasury stock back, you are reducing assets with the cash. You're also reducing stockholders equity when you buy your own shares back. Okay, I want to repeat that so you can write this down. This is important. When you purchase treasury stock, this is the corporation. When a corporation purchases treasury stock, it decreases assets and decreases stockholders' equity. So the purchase of treasury stock decreases assets, decreases stockholders' equity. So we purchase treasury stock, we're decreasing total assets, we're decreasing stockholders' equity. That's what happens when we purchase treasury stock. Decrease total assets, decrease stockholders' equity. Okay, so here's an example. We bought stock back, we debited treasury stock, which decreases stockholders' equity, and we credited cash, which decreases total assets. A note, again, don't write this whole thing down. The point of this, treasury stock on our balance sheet is shown at the end of everything, and it's a deduction. It reduces stockholders' equity. If we have treasury stock, it has parentheses around it, and it reduces stockholders' equity. Okay, if we resell treasury stock, there's no gains or losses on our own treasury stock. Okay, so no gains or losses. We cannot record a gain or loss on buying and selling our own stock, because that could lead to all kinds of crazy transactions. So basically, if we sell it again, it increases assets and equity, but there's no, the big point here is no gain or loss if we reissue treasury stock. Okay, and then the purchase of treasury, we have a question coming out here. The purchase of treasury stock by a corporation increases total assets and stockholders' equity. So this is when a corporation buys treasury stock. Does it increase total assets and stockholders' equity? The key word there is increase compared to your notes when we just talked about it. Hasn't started yet. Class hasn't started yet. This is the first class. Class hasn't started yet. This is the first class. You're in the next one. Yeah. Come back in 10 minutes. Okay, so the purchase of treasury stock by a corporation increases total assets and stockholders' equity. Right now, there's a majority right, but not a strong majority. So when we purchase treasury stock, when a corporation purchases treasury stock, think about it. When we purchase treasury stock, we're paying cash, okay? If we pay cash, we're reducing assets, right? And when we get treasury stock reduces stockholders' equity. So this question is saying the purchase of treasury stock by a corporation increases total assets and stockholders' equity, true or false. The key word there to zero in on is increases. Does that transaction increase total assets and increase stockholders' equity? I'm going to close this question in about 10 seconds. Okay, and this is false. Okay, as we said, when we purchase treasury stock, it decreases total assets, it decreases cash, and it decreases stockholders' equity. Okay, now, when we purchase treasury stock, it decreases total assets and decreases stockholders' equity. When we issue stock, so let's think about issuing stock, because this is coming up on the next question. When we issue stock, what happens? When we issue stock, we're increasing total assets because we get cash, and we're increasing stockholders' equity because we're issuing stock. So the buying back treasury stock and issuing stock, those two transactions are exactly opposite. They're opposite of each other in terms of impact. When we buy back treasury stock, we're reducing assets, we're reducing stockholders' equity. When we issue stock, we're increasing assets and increasing stockholders' equity. So issuing stock is opposite transaction type thing than buying back treasury stock. Okay, so that brings us to our next question. Okay, So, does the purchase of treasury stock have the same effect of issuing stock? So the same effect on assets, the same effect on stockholders' equity. Is that true or false? Does it have the same effect? Okay, to answer this question, think about what we just did. We said when we issue treasury stock, we decrease when we buy treasury stock, we decrease cash, we decrease total assets, and we decrease stockholders' equity. So that's when we purchase treasury stock. When we issue our own stock, people are paying us cash. So think about the impact of issuing our own stock. Is that the same impact as when we purchase back treasury stock? I'm going to close this in about 10 seconds or so. Okay. Issuing stock and treasury stock are opposite of each other. They have opposite impacts. Okay, that brings us to the end of what we're going to do today. We'll finish up the chapter on Wednesday. So I'll see you on Wednesday.